tax planning mistake number 4, failure to keep adequate receipts for business expenses and risk losing tax deductions if you're audited by the IRS. To me, this is so important. You know the 3 things you need to do to not be worried about an IRS audit? Number 1 is documentation. Number 2, documentation. Number 3, documentation. I can't overemphasize it. I've been doing audits for 40 years. They never, quite frankly, I'll be honest with you, if you show a receipt, they accept it. They never do any background checks. They don't do any follow-up. Whatever you show on paper in front of them, gone, done, you know. I went through an audit with a lady from Fort Thomas, Kentucky last year. She was going, and so she got audited. She did TurboTax. Deductions were, it flagged it for an audit because the way where she claimed her deductions, the dollar amounts, and that's how they schedule a client for a tax audit, is if you have excessive deductions relative to other people with your income, and they measure that, they score your tax returns, and that's what the flag is. And I got to tell you, the audits I get are all on Schedule C's. I rarely have any other. I have clients that sometimes I had a client that her charitable contributions were $250,000, so they wanted to get receipts, and she really was that charitable, okay? And it was easy to provide the receipt. It was a simple audit. We just sent them the receipts. They didn't do any audit. I got to tell you, today, if you do an audit, guess what? This lady from Fort Thomas, they wanted every bank account she had, personal and business, okay? And they wanted every receipt that she had. Guess what? She didn't have all her receipts. So this is how you kind of work with the IRS, and I got to tell you, you try to put your best foot forward, so you show the documentation, but it's one of those things that you try to, I guess I feel you try to get into the agent that they like the client and they understand the circumstances, and so, you know, I will tell you this, she had a home office, and the agent, for the first time, wanted to go visit the home office in her home. When he asked me that, I said, oh, by the way, this audit caused her to get separated. She's no longer in the house. Okay. It was interesting. She didn't have records, you know, for some of the accounts. I also had to counsel her about her business expenses in Orlando, in California, and New York City. Now, again, I don't know what she did, but I did explain to her what she needed to do. That if you have, I'll give you another example of how to plan your IRS audit. If you're out of town on a trip, you have to have more business days than personal days. So if you're out of town for 7 days, 4 days have to be business days. You just can't take a trip for 7 days and do business 1 day. IRS regulations have a rule that if you spend 4 hours a day, then that's business. So you have to have meetings and you have to document who you talked to, which she was able to do, that when she went to Orlando and New York City and California, and when she went to Disney and Orlando, that she, you know, she met with people for her business, and she documented that for me. And there's a special rule that says if you have a meeting on Friday for 4 hours and you have a meeting on Monday for 4 hours, Friday and Monday are business days, and if you have to have meetings on Friday and Monday, then Saturday and Sunday are business days. So you only really have to work 8 hours in a 7-day period to have a 7-day vacation in Orlando. Actually, the IRS regulations give an example of going to Hawaii for 14 days and working Friday and Monday on consecutive weeks, and you only have to work 8 hours each week in Hawaii, and you can have a 2-week vacation in Hawaii. Okay? So these are the tax rules, and the IRS agent, well, quite frankly, it went a step further. She explained why she didn't have all the receipts. They didn't match up. And I was kind of shocked. I've had this a couple times, quite frankly, and we got a no change on the audit. I cannot explain it. I've only had that 2 times. The other time was a doctor who went to H&R Block, and the books were cooked. He had significant income. He had a Schedule C where they were making $300,000 in medical director fees. He was a doctor, right, at different hospitals and places. And he had a $200,000 loss in his business. You're talking about $500,000 of deductions. Now, you don't understand why he got audited? So we took the initiative, and that's what, you know, he had no receipts, nothing. So I explained to him that he moved, he lost the receipts because he didn't have any receipts. But I said, besides, So the IRS will accept reasonable records if someone has a fire or flood, right? Or you move and you lost the records. That happens, right? So I was able to get this doctor deductions of $50,000 with no receipts on his tax return on Schedule C. So I was able to salvage something. I had to be reasonable, but we were able to identify expenses that you would expect to have. So that's something that they look at, is whether it's reasonable or not. And when you have to reconstruct information, when you don't have receipts, they will look at what is reasonable. Interesting, isn't it? It does work, yes.
When you say receipts, is a credit card statement considered a receipt, or do you have to have that little?
Fantastic. The credit card is proof of payment like a check. That's half of the problem. You got solved. So you can show proof of payment. You need to have a receipt for every credit card statement, every bill. So I recommend that you keep an envelope and just dump all your credit card receipts in an envelope. And if you get audited, pull out the envelope, because they're going to have to get organized, and you have to provide the receipts. They don't know if you went to Home Depot and bought something for your house or bought something for the office. Okay? So it's really important to keep. That's an excellent question. That was in my notes, so that was a good segue. Yes?
Bill, I have a question.
Sure.
You're talking about all this. How far back do we have to go?
Well, let me explain the rules of that.
I have all this shredding stuff. I'm
Okay.
going to take that pen and take it
Okay.
back.
Yeah. They can audit you for 3 years going back. From the time it depends when you file the return, okay? So if you have an extension in October, then 3 years from October for that year, okay? However, if you understate your income, I'm talking about income, they can go back 6 years if you understate it by more than 25%. So people that do not report income have a 6-year window. They can audit you for 6 years. If they can prove that you had income not reported, they can go back 6 years. If there is fraud, they can go back indefinitely. There's no statute limitations. So as long as you have a clean nose, keep yourself squeaky clean, typically it's 3 years, okay? However, if you're selling stocks or if you have a house, I'm going to interject that right now with the Trump reform. One of the changes is that you have to hold, your house has to be your principal residence today 2 out of the past 5 years. The new law will be 5 out of 8 years. Okay? So that's another example that, again, not knowing how long you're going to be in a home, I would want to keep your receipts. And the exclusion is $250,000 per person. Married couples, $500,000. So if you can get into that window, you're okay. But if you miss that new window, that's going to be prospective then. If you sell down the road, they can change the rules down the road. So now I would say for your principal residence, if you make a major improvement, roof, add on an addition, windows, and I will say I've had to go through audits. We showed pictures. People have owned a house for 30 years. They know that they've made improvements, and we give them numbers, and they have accepted numbers that are reasonable. You're allowed to reconstruct, but it's got to be reasonable. Okay? So it gets complicated. Any other questions? One other rule of thumb I will tell you is this. We do a power of attorney with our client. My client never talked to the IRS, the lady, because she could say the wrong thing. They could also ask her a question. They could tell from her eyes, uh-oh, I'm in trouble. So as a rule of thumb, you have your CPA meet or your attorney with the IRS. I know nothing. And I say, I don't know. So I get a list of questions. I review them with her, and then we strategically then get the information together to have an appropriate response. That strategy I've been doing for 40 years, and it is very effective.